The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everyone, and welcome to Squawk Box. Here are your headlines. The S&P 500 sees its best day in almost 2 years as better-than-expected jobless claims help to allay recession fears after a rough trading week. But Asian stocks falter late in the session as markets struggle to recoup ground after Monday's historic sell-off.
Chinese consumer prices come in hotter than expected in July, lending support to Beijing's drive to prop up spending. And Donald Trump wades into the rate debate, saying he should have a say over the Fed if re-elected, after backtracking to agree to debate Kamala Harris in September.
We were given Joe Biden, and now we're given somebody else. And I think, frankly, I'd rather be running against the somebody else, but that was their choice.
Well, it certainly has been a noisy old week. We often joke off camera that we made it to Friday. I think there's a lot of people in the markets feel they actually made it to today after what has been a market rout, a bounce back, but still lingering
not much
questions.
hurt, right?
Well, yeah, interesting, isn't it? You get a lot of movement intraday, but then over the course of a trading week, we haven't strayed too far. So that is fairly extraordinary. If you look at, for instance, what the Dow, 0.5% swing to the downside and clearly in the red, but 0.5% is nothing to be alarmed about in a normal market pattern. The FTSE down by about 1/3% over the trading week, and the DAX actually trading up by about 0.1%. So if you had just tuned off and you just came back and looked at the ranges for the trading week, you think, well, nothing really happened, did it?
Even out of Asia, actually, right? So if you look at the Nikkei, I mean, we had that prodigious 12% decline that you saw then on Monday, thinking, oh, okay, now it's going to go down quite significantly. It's only 3% down for the week, and I say only. I mean, yes, it is still sizable. But when you compare it to that loss that you saw then on Monday, one could have thought that perhaps there would be a massive drawdown still happening. But still, not significantly lower than over that period as one would have thought on Monday.
The reality is we're wearing some emotional scars after this trading week. Do we still have the same confidence that we can avoid a recession? Are we confident that some of the technicals are now out of the system in terms of the unwind of the carry trade? All things we're going to be discussing at this hour. And we've got a charters coming in. I think important that we look at some of the technicals as we try and see our way forward from here. Yeah,
certainly so. And of course, the economic data has been very key to that. But let me take you to this market picture, in fact, then. And it really is this market rally then yesterday, which was a significant push forward. What actually happened? Well, a lot of it was actually based off of the jobless claims numbers. Very interesting that the decline that we saw, especially at the start of this week, was because of jobs data or the labor market. And now this significant push higher is again because of labor market or the jobs data, and that's initial jobless claims, which actually came in a little bit less than the market had anticipated. And because of that, then we saw a little push then for this market significantly higher yesterday. Nearly 3% gain for the NASDAQ composite. Again, a lot of those tech counters moving higher. And as you can tell then, again, for the week, even just on Friday alone, just yesterday alone, should I say, 5,319 points gain for the S&P 500. Significant boost there compared to where we had seen that market play out this week. And then this is what you're seeing week to date. Yes, markets are down, but when you compare to where they were at the start of the week, it really has recovered quite significantly. The tech stocks are the ones that really moved the needle again then yesterday. All of them sitting in the green, as you can tell then from this board, the Mag 7 and others then as well, including Netflix, which is up more than 3% there in this trading picture. Nvidia recovering more than 6%. In fact, then in yesterday's trading, we're of course still waiting earnings out of Nvidia. This will very likely determine another footpath in this market picture. We had seen some weakness perhaps come through. Yes, a lot of these tech players actually beat estimates, but it wasn't as dramatic a beat as you had seen previously. So it seems that a beat is just not good enough. It has to be great, unfortunately. So what does Nvidia have to say with regards to that? Even Tesla managing to move up 3.7%. The chip makers, well, this is going to be an interesting story, and this story is actually bound to continue. In fact, you've seen gains even yesterday. So the semiconductors perhaps coming back. The semiconductor index has actually been one to look at, the VanEck index. As you saw some weakness coming through there, now beginning to rise back up then. You're seeing the likes of AMD, which are anticipated to have been making a gain on the back of NVIDIA's shoot higher, nearly 6% to the good there, nearly more than 6%, especially across the board. Interestingly to note as well, TSMC, the world's largest contract chip maker, has contracts with both NVIDIA, even with Apple, of course, then tomorrow they will give their latest monthly sales update. That'll be very interesting to look out for as well. What does that actually mean for chip demand across the board? Now, we head off to the Treasury picture here. They've spiked yesterday following firmer than expected employment data stateside. You had seen these 10-year yields actually hit around 3.9 as well at some stage. So there's a pickup for you then in the yield picture, 3.96, but still below 4% for the 10-year. The 2-year note sitting just at that 4% mark then at present. Now, the Asian equities, well, they've faltered in the late session after a volatile week. JP joins us then from Singapore with more. We had initially seen the Nikkei actually, JP, go down around 2%, but I mean, that's kind of recovered really today. So adding more than 2% at some stage, and now just around that upside, but only flat.
Yeah, absolutely, Arabili. But first, we have to acknowledge the tremendous and volatile week that was. And boy, I will have to admit, watching these markets for the last 5 days has left me quite exhausted, especially after that big drop. And again, as you mentioned, that nice recovery that we saw from Asian stocks led by the Nikkei 225. And I do want to point out again that that relationship that is between the Nikkei 225 and the Japanese yen, because again, that unwind of the carry trade from the yen, which saw it suddenly strengthen, really sapped a lot of confidence, almost wiped out the year-to-date gains of the Nikkei 225. But as you mentioned, they've recovered quite nicely and again are starting to come close to perhaps recouping some of those losses that they saw earlier this week. A lot of this also down to uncertainty about the U.S. economy that was sparked by that weak jobless report that suddenly raised concerns about a possible U.S. recession. But America, especially based on the recent jobless claims that we saw yesterday, it seems the U.S. economy is doing a bit of a Mark Twain right now, saying that rumors of my demise are greatly exaggerated, and we've seen some confidence return back and also filter into these markets. But it is the yen also, and you can see that relationship between the yen and the Nikkei 225. Whenever the yen weakens, we start to see the Nikkei 225 gain because of the exporters, and again, vice versa. When the yen strengthens, it saps confidence. But again, we're starting to see that perhaps the Japanese equities are becoming more sensitive actually to yen fluctuations and movements. And the question, of course, of whether or not that carry trade is unwound is on everybody's lips at the moment. Some do think it's safe to go back to the water, but again, it's a rather sensitive time to be in Japanese markets. Another market worth tracking also here in Asia is the TAIEX. Again, the very tech-heavy TAIEX, which is dominated by the likes of TSMC and Honhai. They're also coming close to recouping some of those stark losses they made so far this week. We're looking at TSMC now, shares up by about 3.5% so far in today's session, also driving this recovery for the TAIEX. They still have a bit of a ways to go, but it seems that they're making up some pretty decent ground. Other markets recovering at slightly slower paces. We have the Kospi, for instance, South Korea, and the chip makers also scrambling to bounce back, but they're still down about 3% so far week to date. The ASX 200 also, now you're seeing them actually flashing signs of being down by about 2.3% in today's session. And again, Chinese markets didn't see as stark of a sell-off, but again, also because they're also worried about possible slowdown signs in the Chinese economy. We got some better than expected Chinese CPI data that pointed at perhaps some signs of a very slight recovery, at least in terms of Chinese consumer sentiment. But keep in mind that factory gate prices there, the prices that are faced by many of the factories and the industrial sector there, once again contracting, and thus saying that there's still a lot of uncertainty with regards to the world's second largest economy and whether there is a slowdown. So still a lot of uncertainty, still a lot of reasons to be a bit worried. But so far, based on the last couple of days, it seems that Asian markets are taking a bit of a breather, and we'll see if they can take a second breath when we come back online next Monday. Back to you guys, and good morning.
JP, thank you very much for bringing us that roundup. Let's push on to the data as US jobless claims fell more than expected, coming in at 233,000, helping to allay fears of a potential recession that drove much of this week's earlier sell-off. The weekly claims data pushed US stocks higher, with markets still seeing a 50 basis point cut from the Fed next month as the most likely scenario. Ron Williams joins us now, CIO and tactical strategist, RW Advisory. Ron, it has been a wild week for traders, for markets. The S&P 500, let's just start there, because if you look at the trading week, we're still at 0.5% roughly, fourth negative week in a row, but we did have this fairly decent rally yesterday, 2.3% pop. Rally or ruse in your book?
We will likely get a mix of the two. Tactically, risk reward has clearly improved post-crash, but strategically, a top is in. But that will likely play out for the remainder of the year into 2025. That's our base case at RW Advisory. Our thesis has been a behavioral inflection point since the start of the year, which is now reversed. But essentially what that means is a bull trap squeeze where there's a lot of leveraged bullish views on the back of a consensus soft landing view, which ultimately is now make or break. And so the key level to be watching on S&P 500 is at the 5,200 mark. That will decide whether this bounce back holds or whether we break down lower. Certainly we could get an in excess of 10% correction into the 15% mark or more.
So those who are not familiar with the term bull trap, just again, this is a potential exit point actually for investors, not an entry point.
Absolutely, it's for selling. And it's basically when a lot of the bullish consensus is proven wrong. So for that reason, it can be quite dramatic, and that's certainly what we were looking for over the last tactical period, because the markets were under pressure, a triple whammy headwind of extreme momentum, rotation fragility, and cycle asymmetric risk.
Ron, let's just get into some of the graphs as well that you have put forward. And if you talk about that bull trap reversal pattern, I'm just wondering then, is that make or break zone as difficult one, or is that where you think that markets will really just continue to head completely lower, especially if passes below, what is it, just below 5,200? Is that a key level then that you're fearing right now in this market play?
It's a key level that the market must test and prove itself, as it were. Each market crash is different to another, but they tend to follow a three-stage pattern: fall, rally, then rest of fall, or a variation of that. So we do need to watch the charts to see how that plays out. Scenario planning is a great idea. Right now we're base case looking for lower levels ahead, but certainly there are other likelihoods. Keep in mind what happened in October, where we did have a drawdown to the effect of about 10%. That would equate to the long-term 200-day moving average here and now.
We did have April, though, and if you look at the chart back in April in the S&P 500, it looks like that could have been the same pattern, right? We had a sell-off, we had a bounce back, a bit more selling, but actually then ultimately we went up. We didn't go down, and we went up a fair amount. So why is this not April?
Yes, well, time has passed and the markets became more overextended in terms of the original three factors mentioning the excessive momentum, but also the fact that we had ongoing signs of rotation fragility. And back in Q1, tech seemed to look even more frothy. Then we had that fast rotation into value, which wasn't viable or sustainable. And so in a way, it was the last trigger to take place. And we've since had a perfect storm of other factors that have triggered the market down.
I'm actually just looking at the graph we had just a moment ago as well, and really just talking about those tactical risks, particularly in the Q3 to September or so, then as part of a strategic top then by 2025. I mean, does that ultimately mean that we're going to see this market still actually lose out quite significantly as we head into next year?
Eventually, yes, and certainly having a barbell strategy where we can remain long of those selective profitable trades, but trim where necessary, hedge downside risk, especially into year end and the new year, as well as remain diversified somehow, some way. Gold is a good play still, especially on a relative basis. The cycles tactically, based on a range of different drivers on the screens, is a proprietary model by the Foundation for the Study of Cycles, where I'm part of the team. That shows the marker for the fall that's already happened, but also the peak that preceded it, and a bottom in September where most of the traditional drawdown is. That's confirmed by the typical negative seasonality of Q3 into September more so. We have the Fed policy meeting then, so that potentially some event risk. And then not so later afterwards, we have US elections in November. That amplifies the negative skew, particularly this year where uncertainty is more heightened, plus we have geopolitical risk, which just to add a little bit more concerns to that. Long term, what this all suggests on the chart on the right, that this is likely part of a strategic top in play for the new year.
I did wonder whether there was going to be some sort of bookend to the uncertainty thanks to the US election in November. I want to ask you about the Japanese yen, because this whole carry trade unwind, part of your perfect storm scenario, seasonality, and then you get this big feature in markets as well. What deleveraging do you see ahead on the charts?
Well, mid-year is typically repositioning, but more amplified clearly because of the deleveraging shock that took place post yen carry trade debacle. The chart suggests that there is further yen unwind ahead, dollar yen unwind, I should say. More pain potentially for those still relying on that trade. On the chart, we see a potential move below 140 is the big support level. That would be in line with the decline we saw in previously. Also, of course, this would have cross-asset implications in terms of those high momentum trades, and from a cycle perspective, also looking like we might get some relief oversold reaction now, but further downside into the new year. So there's this question on perfect storm. What else could happen between now and year end that could perhaps weigh more on the markets?
Yeah, it's a very interesting one as well. Then let's just go to your last one, and this I think is the very interesting one. Really just talking about your recession alert here, and obviously this week the market has certainly looked at that and thought that that was going to be a key factor. That was bound to be happening now because of the data that we saw last week Friday on the jobs front. And it seems like, again, the curve steepening again, ultimately indicating exactly that.
Yes, so curve steepening, we've been there before, back again, but this is now bad news being bad news. The market is actually factoring this in. Fear has already come and passed, and those emotional scars that you were talking about are certainly still there for many, although we will be reevaluating here and now. This confirms that we do need to wait for further inversion, just to give more extenuation, as well as have a time lag of about 6 months or so. Again, this takes us into the new year for those potential economic pressures to follow. Keep in mind we've had macro surprise indices negative month on month, GDP slowdown, which has been the main concern, inflation's stickier, and more recently labor being more skewed. Essentially, this is telling us what we already are concerned about. Keep in mind also we have a tech-led downside skew, gold-copper ratio pointing up. So there are other proxies also supporting this inversion. And it also cries out for the Fed meeting to come as to whether they cut soon or later. Either way, there seems to be a checkmate position.
What's the ability for chartists like you to see a recession? Because there's been a lot of debate that economists often miss it, and you expect economists to be able to see recessions. But what's your ability to see a recession like?
All from a behavioral sentiment perspective, added on with macro and tactical overlays. What's interesting is that we're at all-time extremes in terms of a bullish soft landing consensus, and that was as of last year. Second to that flipped from a very bearish time where 100% likelihood of a recession flipped, and many were on the wrong side of that consensus. So we seem to have doubled down the other way, and that tends to be a contrarian signal, particularly if it's supported by further macro indicator pressures and tactical turning points like the ones that we've had. So certainly good time to remain cautious in that barbell strategy recommendation.
Just quickly, in about 10 seconds, how extraordinary a week has this been for you as a chartist?
So it's been weak enough as part of a flash crash, which is what RWA originally predicted for Q3 in August. But there is further downside. It is only about 10% on equity markets in terms of the US and Western markets. Japan, of course, took the stronger hit, and that was an 87 style move. And certainly the VIX, greater than COVID 2020, certainly a Volmageddon event.
Thank you so much for joining us, Ron. Ron Williams with our CIO and tactical strategist, RW Advisory. Well, later this morning, we'll be speaking to Sean Pesh, who is Ranmore Global Equity Funds. He runs that fund. Last year, beat the S&P 500 without holding any of the Magnificent Seven. We're going to discuss how he did that at 9 CET.
And also coming up on the show then, Donald Trump says the president should have a say in Fed monetary policy, arguing he has better instincts than the Fed chairman. We'll get into that discussion. Plus, getting the bacon. Surging pork prices push Chinese inflation to its highest monthly rate since February. We'll go through the details later this hour. And net profit surges more than 40% at Illimity in the first half of the year. Then we'll hear exclusively from the CEO, Corrado Passera. That's happening at 8:30 CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
To the politics stateside, former President Donald Trump has agreed to stick to the original plan and debate Democratic nominee Kamala Harris on ABC in September, changing tack after demanding the event be hosted by Fox News, which is more popular with his base. On X.com, formerly Twitter, Harris said she looks forward to it now that Trump has, quote, finally committed. However, Trump now wants to do two more debates, one on Fox and one on our sister channel, NBC News. The Harris campaign says the Fox suggestion is off the table. Trump also weighed in on the rate debate, telling reporters the president should have a voice when the Federal Reserve makes monetary policy decisions. Speaking at Mar-a-Lago, Trump said he thinks he has better instincts than Chairman Jerome Powell or people who work for the central bank. The news comes as Americans weigh in on financial issues as part of CNBC's latest All-America Economic Survey. Steve Leisman filed this report.
The CNBC All-America Economic Survey finds former President Donald Trump holding a commanding lead among American voters on key economic issues, but ahead of Vice President Kamala Harris by just 2 points in the race for the White House. Trump led Biden by 45 to 43% in the July NBC News survey. The CNBC August survey finding Trump leading Harris by 48 to 46, or the same 2 points, and within the polls, 3.1% margin of error. Yet by a 2-to-1 margin, 40 to 21, voters believe they will be better off financially if Trump wins. 35% say it will make no difference to their pocketbooks. That number is driven by Republicans who strongly believe it matters for their finances if Trump wins. 42% of Democrats say it doesn't matter, along with 54% of independents. Just 17% of Republicans say it doesn't matter. Trump also has double-digit advantages on several key economic issues. Voters who say inflation and the cost of living are a top concern, they break for Trump by 12 points, 53 to 41. Voters who say the country's overall economy is a top issue break for Trump 52-41. The two are tied at 47 on addressing the needs of the middle class. Harris has advantages among voters on the issue of health care and protecting democracy. She also leads on the abortion issue by 22 points. Trump gets considerable voter support on the crime and safety issues, along with immigration and border security and taxes. The two are about tied when it comes to Social Security. So if the economy is so important, how is the ballot question so close? Well, it may not all come down to the economy. Harris has a 1-point lead on the question of who will be best to deliver positive change to the country overall, an important indicator of what pollsters call a change election. 16% are unsure, suggesting there's still ground to be gained by either side. The survey shows both sides have now consolidated their bases, but neither has made particularly strong inroads among the swing voters who will ultimately get them into the White House. Steve Leisman, CNBC Business News.
Pick up on the point on just how much say we would want Trump to have over the Federal Reserve if he is re-elected. And it does tell us, I think, this report, don't forget, there was a report that circled back in April about this type of influence over the Fed. And at that stage, Trump distanced himself from it. So just how aligned is he to some factions of the party? But the impact, what impact would there be on debt and the US dollar as a reserve currency? And don't forget, the independence of the Fed is seen as a key check and balance over the strength of institutions stateside. So would it cause a wobble? And where there have been very little concerns around the amount of debt in the United States, could it actually double down the bond vigilantes on the US position? So that would be key. But don't forget, I mean, what president, what politician is incentivized for interest rates to go up to fight inflation. And I think we've all just seen the impact of inflation, the lessons that brings to an economy.
Yeah, look, I think you're so right. There's so many elements to this that perhaps offer so much contradiction to where exactly the US would get a lot of its gains from, right? As that currency, of course, that everybody else looks towards as well. What is it that you'd actually benefit from removing that independence for a currency like this one? So I think this is a conversation that obviously worries, because if Donald Trump does indeed stick to his word, you could see a lot happening.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.